your money in futures and options. You could be buying mutual funds. You could be playing with the unlisted market, the pre-IPO shares. You could be investing in IPOs. There's so many vehicles in a specific asset class also. So that is when we decide our strategy that, okay, I'm going to be investing in 2, 3, 4, or 5 asset classes. And then let's see what vehicles can I use to ensure the returns which I have set out as an objective. Right? As soon as that strategy is decided, I need to implement this strategy. What does that mean? I've created an objective of 15% returns or 14% returns. I've decided that, okay, I'm going to be putting money in, say, equity and debt only. That is the strategy which I have done. And then once I have decided what vehicles I have to go ahead and invest, it could be stocks, it could be mutual funds, it could be government bonds, it could be debentures, etc. Then I have to go ahead and actually implement it, because a strategy is only as good and on paper as it could be on good on paper, right? You can make your returns on an Excel sheet, but probably not in your bank accounts. So we need to go ahead and implement that strategy. And in the end, we need to monitor the direction. This is very, very important. Think of this as a football game or a football field, right? A striker or the people who are playing, the players who are playing, the only objective they have is to probably score a goal, right?
Mr. Shreyan, can you hear us? Subhara, are you there? Can you make our announcements? Anyway, that connection, it will take time for us to. Yes.
I think I dropped off. I'm really sorry. Yes. So as I was mentioning, so we need to have things in place, right? Now that we've created out an objective, etc., everything, think of this as a football field where an attacker's goal is to only score that goal. That is your objective. That goal post is your objective. And you've decided that, okay, whatever your strategy could be, you're going to take the ball on your own, you're going to pass it to different players, and then go ahead and create that goal. That is the strategy which you've done. Then you practice it on a daily basis, and then only do you go ahead and implement that strategy. And monitoring becomes extremely important, because if I'm the coach, if I'm the CFO of your wealth, if I'm the coach of the football team, I need to understand that whatever our objective was, are we working towards that or not? So when we say monitor direction, at least at Anand Rathi, we have a very, very strict approach that we want to meet you on a monthly basis, irrespective of how busy you could be. We understand that in your professional capacities, in our professional capacities, we might not be able to meet or speak on a daily basis, but at least once a month, we sit down with your portfolios. We look at whatever we have returns have been able to create till date for the financial year since the time we started. And are we meeting that objective or not? Right? Are we on that strategy or not? Is there any deviation? If there is any deviation, what do we need to do to come back to that objective? Very, very academic in nature, but very, very critical. This ensures discipline in our portfolios. Right. So that was wealth, that was management. Now we need to create our objectives, the first goal which we had here, right? So what are the objectives which we found at Anand Rathi for the 8,000 families which we manage? We've been in this business for the last 15 years. We've done our share of trial and error. And these are the 3-4 objectives which we think make a lot of sense to most investors. Of course, some of you could have very, very specific interest or very, very specific objectives that you might have in mind. A children's education in place, child's marriage, probably a retirement home at some point. So of course, we look at those objectives as well, but these are my broad-based objectives. So what is the first objective while we try and manage the money? Of course, those are returns. But as I was mentioning, we have to have an objective in mind. So let's come to this objective very objectively with a mathematical number. And what should that number be? First of all, we need to beat inflation, right? And the inflation number, what RBI tells us, is absolutely not what applies to all members present here. Because when RBI does this math, it takes 56% weightage to food and fuel on a monthly basis, right? RBI's target is 4% plus minus 2%. The maximum it wants to go is 6%. Today, we are trading at 7% because of course, all the global supply bottlenecks and the liquidity crunch that we want to start bringing into multiple economies. But that is still not the inflation what applies to you and me. The actual inflation what applies to you and me is called the HNI inflation. You might consider yourself as an HNI today, you might not, but that is the inflation what actually applies to you. Think about it, because out of the 100 rupees you make on a monthly basis, do you and me spend 56 rupees on food and fuel? Absolutely not, right? We spend money elsewhere. Flight tickets, banquet halls, seminars like this, if that has to happen in a banquet hall, your medical expenses, your children's education expenses, marriage expenses, right? All of these costs have been rising anywhere between 8 to 10%. And you will agree with me that minimum flight tickets about 3 years ago used to be 3,500, 4,000 rupees. Today, open any website, your minimum flight tickets are 6,500. So your costs are rising anywhere between 8 to 10%. Now the current phones or the laptops or the cars which you're using today, I'm sure it's a better version of whatever you were using 2, 3, 4 years ago, right? Because the human mind has a tendency of wanting something better every single time as we go along in the future. That allows us some lifestyle upgrades. Now, for us to beat the HNI inflation, we need to have at least 8 to 10% returns on our portfolios. To be able to afford better phones, better laptops, better houses, and better cars, we need to have some extra return on that inflation number so that we can allow ourselves those lifestyle upgrades, right? So that is my first objective. I need to go ahead and beat my HNI inflation. If you guys have any question as I go along, please feel free to write them on the chat so that I'm on top of it and we don't lose track of things where you probably might want to hold them till the end. I don't mind taking questions as we go along.
What you said is that it could be a retirement planning or child education and marriage. That also can be an objective. We can have multiple
Absolutely.
objectives.
Absolutely, ma'am. So what happens is, if you've decided that, okay, 12 years from today is when I want to send my children for an education, say a bachelor's or a master's abroad, we'll have to consider multiple things there. What could be those multiple things? A, if we want to send the children abroad, what is my average depreciation rate? Say if you want to send our children to the US to do their bachelor's, right? So we understand that, okay, the the Indian dollar, the Indian rupee depreciates against the dollar by about 4% on average year on year. So anyway, that is a cost which I'll have to incur in the next 12 years. If US education is increasing at 10% per year, I'll have to understand that, okay, 12 years from today, this is the cost what I'm looking at. As soon as we put numbers to our objective, it looks achievable and things can be done to get there. And once I know that, okay, I'm going to be spending 100 rupees in 12 years, what kind of money do I need to put in today? What kind of money do I need to keep putting regularly? And where do I need to put it? Because the objective is set. Implementation also has to be done. It also has to be decided. So of course, ma'am, children's education or any other objective that you might have in mind should be a part of your wealth and should be a part of this process. So that is one, trying to create good returns. Then we need to create a safety net and plan for our estate as well. Why is that important? We work 10, 12, 14 hours a day trying to make some money. And this is largely for the future generations because we can only consume so much during our own lifetimes. If that had to happen, and all the money that we've made, if that is not transferred very well to the next generation, we've not been very fair with our wealth. What does that mean? India today has about 85,000 to 90,000 crores of unclaimed financial assets. And these are across all vehicles which you could have think of. Recurring deposits, fixed deposits, savings bank account, insurances, mutual funds, stocks. Because think about it, you would have heard this conversation either with a friend or it might have happened with you. That my grandfather bought or my grandmother bought a piece of share, but it's lying in physical form. I don't know what to do with it. How do I claim that? Right? Because this is something, money is a very, very touchy topic. We avoid speaking about it to our parents, to our spouses, to our children, right? Because we think that, okay, whenever the time comes, I'm sure I'm well equipped to get things done. But how do you ensure that you're well equipped? You have a will in place, right? We think that, okay, I'm going to create a will only when I'm very ill or when it's very, very important for me to do it. We've seen COVID at such close quarters. We don't know what can happen when. We've seen young people pass away. We've seen senior citizens pass away. None of them had planned for it. The last 12, 15 months, we've seen so many professional actors or singers pass away due to cardiac arrests. No one plans for these things, right? But that is a certainty that is there in your lives. So why not plan for it today? If you leave it till the last moment, it might not be possible for us to help you plan that. But if you decide today that, okay, I have a family of n number of people, today I have 100 rupees, and then you decide that, okay, this should go to this person, this should go to that person, that should go to that person. Of course, as we grow along and as the portfolio keeps growing, we can add more family members to it. Say we have a second child, we have a third child, and we want to add them as part of our succession planning. We keep adding them as the portfolio keeps growing, as we keep adding more asset classes. Those things also keep getting added. So having and will registered is extremely important for you, right? This is something what largely chartered accountants and lawyers used to do, but because we've been managing families for the last 15 years, and some of our about 40% of our investors are in fact senior citizens, right? So all of them already have a will in place. Of course, we do reiterate them every 2 or 3 5 years whenever the need be, but everyone has that. It ensures that if something had to happen, the money can smoothly pass, right? Also, India does not have something which is called the estate tax or the wealth tax or the inheritance tax as of today. But till 1985, we used to have that. What would that mean? And it was anywhere between the range of 40% to 90%, right? What that meant is if 100 rupees were to be transferred from my parents to me or from me to my children later, that tax amount would be directly taken by the government. That's not fair to our wealth, right? We've slogged our entire lives to make this wealth, and the government cannot just take us from like that. As soon as we have a private family trust in place, then, right? So, will is one mechanism in which we can help transfer our wealth to the next generation. The second is called a private family trust. We know that out of the 100 rupees which you're making on a monthly basis, 10 rupees is something I don't need at all. So I can slowly keep parking that 10 rupees in a private family trust, and it comes with its own set of clauses, the clauses which you decide for yourself and your family. You decide that, okay, my child today is 4 years old, he will not probably have the discipline to manage the wealth. I have to give it him by the time he's 18 or 20. So I want to give the wealth to my child by the time they turn 25. So you've made a private family trust for 20, 21 years, that the day my children are as old as 25 years, this money can pass on to them, or they can be the beneficiaries of this trust. This is something which we do with, again, most of the families which we manage. You could have different there's a managing trustee in your family trust. There's someone, there are beneficiaries in the private family trust, which could be the family members you want this money to be gradually passed on to, right? So our objectives here till now is trying to beat your HNI inflation, allow some lifestyle upgrades on your portfolio, have a safety net in the form of a private family trust so that it helps you against something like a wealth tax, and finally plan for your estate in the mechanism of a will, where you can have your family members, whoever you want to pass on the wealth to. Now, there's a very interesting thing about safety nets, about private family trusts. And probably not the best example to give, but an example probably everyone can relate with. Mr. Vijay Mallya did whatever he had to in the last 8-10 years, and he's not been in India since then. He currently owes so much money to multiple banks. But I'm sure this question comes up in your mind every single time you look at his life photos, that how is he able to afford that kind of a lifestyle staying in the UK? If all of his financial assets have been attached by multiple banks in the country, mostly public sector banks, right? It's because his father, Mr. Vittal Mallya, had created a private family trust, a Golden Eagle family trust, for which the beneficiaries are Mr. Mallya and his son. So those assets can never be attached to his personal wealth, right? I'm sure none of us have any wrong intentions in our professional capacities, in our personal capacities, but we do end up signing a bunch of documents as promoters of the company, as valuers, all of you, you end up signing so many documents. You never know what can come and bite you back later, 8 years, 10 years later. But as soon as if you have a private family trust in place, your personal wealth can never be attached to it, right? So we should have that in place. Again, these are all sanitary things. The probability of this happening is 1%, but if this had to happen, 99% of everything you've done during a career goes for a toss. You don't want to be in a situation like that, right? So while we go ahead and manage your wealth, when you try and look at managing your wealth, returns are not the only objective. Returns will come because, of course, we are in India, one of the fastest growing economies. Everything is bullish for us. So of course, we'll create returns wherever we end up putting our money. But planning for succession becomes extremely important as well. So these are the three objectives which you work with. Now the inflation number, what I was talking about, because we talk in English and it does not feel, the value does not, you can't understand the value. Look at the numbers and you'll be able to understand. So while I was talking about the 6% inflation target, what the RBI has, that applies to 98% of the population. The HNI inflation applies to only the 2% of the population. Why do we say this? Because India has about 6.5 crores of taxpayers, out of which only very, very few pay more than 50, are in the income bracket of 50 lakhs and above. That could about be 2% of the population. And inflation has been a silent killer in our portfolios. As I was trying to address Shilpa ma'am's question about, say, education expenses 10, 12 years later. If I know that the dollar or the Indian rupee has been depreciating against a dollar 4% each year, I should account for it at least 12 years later, right? If you look at just the inflation numbers, inflation on average has been anywhere between 6%, 7% in the last 20, 30 years, because we've gone through the 1990s, the 2000, and the recent liquidity boom, and now the crunch, right? So if inflation was to grow at 7% each year for the last 30 years, the thing which would be costing you 10 crore rupees 30 years ago would be costing you at least 76 crore rupees as of today, right? We would not have accounted for this. We will probably again miss accounting for this in the future. But the HNI inflation, what applies to you and me, would have increased the cost to 174 crores. Of course, numbers look much bigger when we do Excel extrapolation. This is just that. But this is just to drive the point home that inflation will be a silent killer in our portfolios, and it is extremely important for us to have a look at these. Right. Now that we've looked at our HNI inflation, we've spoken about our objectives. What assets do we choose becomes extremely important. So there was a research done by Mr. Brinson Singer and Mr. Bebo back in 1991 in the USA. And what they had to find was very, very interesting. They realized, and the study actually proved this, that out of whatever returns I have to make, the impact of my asset allocation is 93%. Why is that important? Go back to the objectives which you were discussing a little while ago. If my objective is not very, very clear, I'm going to dabble with crypto, FNO, etc., right? So my asset allocation has not happened. I'm dabbling with multiple asset classes. But now that my objective is set, at Anand Rathi, we follow an approach where we want to ensure that your returns are anywhere between 13% to 15.5% on an annualized basis, right? And we've done a lot of back testing, a lot of data which we've researched and implemented over the last 15 years. We found that two asset classes work very, very well for us. That is probably equity and debt, because equity has a tendency of delivering 13, 14, 15% returns on an annualized basis. Since the time Nifty has started, Nifty has delivered about 14.8% returns as long as we hold it for a 3-year period, 14.83% year on year. That is the asset allocation, what is very, very important. You can decide that you want to put your money in equity and debt. Those are the assets you've chosen. Then we go ahead and choose the securities or the vehicles which we can invest in, like say mutual funds, stocks, unlisted shares, futures and options, etc. Right? But asset allocation is what will determine 93% of my returns. Think about it. A lot of our investors and probably a lot of you all present here might want to invest in real estate. So that's an asset allocation decision that you've made. Now you go ahead and decide that, okay, I'm going to be investing in a property in Indiranagar, in Kormangla, or any other place that you might like. That is your security selection. Then finally, your market timing. You've decided that, okay, this is, say, we're in the middle of the COVID outbreak. You've decided that, okay, this is the time when real estate prices have slumped. So why not go ahead and buy right now? I could get very, very good levels. That is called market timing. We're trying to time the market. But try and understand the same thing in terms of equity. Say we've decided that equity is the asset which we want to invest in. Then we go ahead and decide that, okay, mutual funds is the security which I'm going to be using. Now, even in mutual funds, there are so many categories listed. There are so many mutual funds out there to invest in. India has 5,800 listed shares, right? Probably one of the largest in the world. How do you choose which stock to invest in, right? How do you choose which mutual fund to put your money in? That is security selection. Finally, market timing. A lot of our investors like doing monthly SIPs also, so that even when markets are going through their own turbulent times, you don't have to worry in your professional capacities that when should I go ahead and buy. Do you have the time during the day to probably look at your Zerodha or your Grow or your stock prices? No, because we're busy in our professional capacities. So we want to remove market timing, and the study has also shown that it only has a 2% impact on your returns. So if asset allocation has 93% reasons to influence my returns, we should spend a lot of time on that, right? And we end up spending only 10% of our time on it, which works very well for us because we've done our back testing. We've seen what can create returns in the future. right? And what are those asset classes? Let's just have a very quick look at it. Good part to start. We've gone back 30 years. Why have we gone back 30 years? Because we need to have an apple to apple comparison. Whatever was there in 1990, what kind of returns they've been able to create. So if I had 1 crore rupees back in 1990 and had multiple places to put this money, where could I have put the money? I could have put my money in fixed deposits. At 7% returns in 30 years, my 1 crore would have grown to 10 crores. And I would have been very, very happy, right? That my money has become 10x in 30 years. But look at the returns which you're making. It's only 7%. We're not even beating the RBI inflation. Leave trying to beat the HNI inflation. Plus, there are taxation limits on it. Every time you have an accrued income at the end of a financial year, you need to pay taxes on it, right? Look at gold for that matter, something which we really, really like, right? That we should have gold at home no matter what, or we should probably invest money through gold ETFs. That would have grown to about 15 crores only. That means only 9% returns per. Look at the real estate. We've looked at prime locations, Delhi, Bangalore, Bombay, Delhi, Vasant Vihar, Bangalore, Koramangala, Mumbai, Malabar Hills. It would have grown to 19 crores, 21 crores, and 24 crores. Again, only a 10 to 11% per annum returns. In multiples, it looks beautiful, right? One has become 21. Wow, 21x. I bought this when the square feet price was only 1,000 rupees. Today it is 21,000 rupees per square feet. But let's annualize it. We're doing everything on an annualized basis. Our CTCs are annual, our valuations are annual, our projections are annual. Then why don't we look at returns on an annualized basis? Why do we look at it in terms of multiples? That becomes very, very important. This is my largest equity index, Sensex 30, right? This would have grown to 60. One would have become 60 in 30 years. That means 14% per year, right? And which is a massive number. The best way to look at something is where if you want to see how fast does your money double, put 72 on your numerator and put the interest number or the return number in your denominator, and you can come to a value. So if you look at 14%, 72 divided by 14% gives me about 5.2 years. That means my money doubles every 5 years as long as I'm invested in the equity markets. To drive this point forward, just assume, we've picked up 4 mutual funds back from 1990, which were in operation then. The charts which will come up right now, you'll be extremely surprised to see the kind of returns they've been able to create in the last 30 years. And here this goes, right? So HDFC FlexiCap has been in operations for the last 30 years. Your 1 crore would have become 400 crores. Right? We keep hearing about if you had put 1 crore rupees in Infosys in 1980, it would have become this much, or 1990, if you had invested 1 lakh in Wipro, this would have become this much. Again, look at mutual funds, what they've been able to do. As high as 700 crores. Your 1 crore has become 700 crores in a gap of 30 years. We would probably want to be in this place, right? And this is what an objective-driven method can do. It can help create out an objective that I need to beat inflation, I need to have lifestyle upgrades. As soon as you have that point in mind, you know I need to create at least 14-15% returns. Then you've gone ahead and selected, okay, equity as an asset class, that is what I'm very comfortable with, or something what my wealth manager or my relationship manager can advise me for. Right? We've selected equity then. Then we go ahead and select mutual funds. Why do we select mutual funds is extremely important. Please try and understand that as well. We want to invest in stocks. That is where the returns comes from, right? Because even for mutual funds, your stocks are the underlying assets. If my stocks are the underlying assets, they have a lot of volatility on a daily basis. Again, you and me in our professional capacities, we don't have the time where we can sit, monitor it on a daily basis and see if my portfolio is being able to create those returns or not. Because there are 2 legs to making returns on a stock, buying right and selling right. Very difficult to get both legs right. So we like outsourcing this job to a mutual fund manager who's subject to regulations by multiple bodies. The SEBI will monitor him, his own company will monitor him, the Bombay Stock Exchange will monitor him, the Association of Mutual Funds of India will monitor him. There's so many people trying to monitor him. Plus, he's a professional at doing it, right? He's been doing this 10, 12 hours a day for the last 15 years. His probability of choosing your vehicles is much higher and making returns on that is much higher than you and me. And they've been able to create. We have data in front of us. And this is what having a wealth advisor can bring to your table. Right? I have some questions. I'll just
I don't want to
ahead.
hurt your sentiments, Shreyan, on this point, but then I have heard that, a few HNIs worried that, his advisor didn't advise him properly and he has lost, couple of wealth. So
Right.
you can address that issue as well.
Right. If you could just come back with your question, I lost you in between. Really sorry. If you could just come back with your question, ma'am, I couldn't hear you very well.
Actually, I didn't want to hurt your sentiments on this statement, but then
Right.
I have heard many HNIs
Right.
feeling bad that their wealth little bit, got eroded because of the wrong advice given by the advisors, and
Absolutely,
then,
ma'am.
they losing on it, they had a sense that, is it right or not, but then they banked on the advice and then they lost a lot of wealth, almost like forever kind of a thing.
Right.
Just you can help us to understand how
Yes.
we can be careful not to,
Yes, ma'am. So first of all, choose someone who comes with a lot of established background, right? Who has a lot of skin in the game as well. What happens a lot of time, wealth managers would probably try and advise you on asset classes or uh, sell things. There are two ways of doing wealth management.
yeah, selling
One
things.
is
That is where
stealth
I was about
management.
to.
One is stealth management. If I'm your bank relationship manager, I will know every time you have money in your account, and I will come and tell you, ma'am, please buy insurance. No, this is a very good insurance, etc., etc. Ma'am, please put money in fixed deposit. Please put money in recurring deposit, because if we have to understand how do they make money on it, probably, right? Insurance ends up where if I've paid the first premium, that money goes directly to the relationship manager's pocket, right? About 70-80% goes directly to his pocket, and you still end up paying decent premiums as you go along till your premium term is there. You end up putting money in recurring deposit or fixed deposit because it looks very easy for you, right? Same bank account, 2 clicks, and I'll be able to have a fixed deposit. It's ease, but it's not helping us create those returns. So while I talk about credibility, and of course, I can only represent myself. So Anand Rathi Wealth, we got listed last year. Last December, we got listed on the Indian stock market, and we are the only pure play wealth management company to be listed on the stock market. That gives us a lot of confidence because getting listed is a very cumbersome and a very nice, rigorous process to ensure that we are doing things very, very well. Right? We also get our final financial audited reports from one of the big fours each year. That also allows a lot of credibility in what we have to do. Right? So choosing a credible wealth manager becomes important. Do your due diligence. Bank managers will always try and sell you products. At Anand Rathi or probably the good wealth management firms, product selling will never be there. It will always be an objective driven method. As soon as you have an objective in mind, you know that insurance will give you 7.5, 8.5% returns at best. Maybe except ULIPs. I'm looking at traditional plans. Your life insurances, your health insurance will give you 8.5% returns, right? As soon as my objective is not in place, as if I know that, okay, my objective is 8%, I'm okay with that. But if my objective is 13, 14, 15% returns, I will not even want to buy that insurance. Why are we buying that insurance? That, okay, if something had to happen to me, the money has to be transferred and my family has to be taken care of. Most investments today have a nominee in place. You know, if something has to happen, who the money has to go to. That is why we like creating wills as well, right? So choosing your wealth manager becomes very, very important. Of course, there will be bad apples in a place, but that is not something which we can, predict. But we can do our own due diligence by the time we go ahead and select a wealth manager and understand their approach. That is again something which we love doing at Anand Rathi. Even while we are having this webinar, some of you might be interested in taking this forward or might not be. But I'm never going to come to you and say, sir, okay, you were on the webinar. Please give me all the 100 rupees you had. No, we'll spend 3-4 meetings with you. We'll spend 4-5 hours with you trying to understand your objective. We'll tell you what we have to offer only and only if it makes sense to you. Will we take this relationship forward? At any point you think that, okay, whatever this guy has to offer does not make sense to me, we don't take it forward. Even after 5 meetings, 4 meetings, you understand what I have to offer. Does it make sense to your goals, your objectives? And only then do we take it forward. It's absolutely non-obligatory in nature. Because I cannot come to your home and say, no, ma'am, please give me a check. We spoke on the webinar. No, never ever that. Because I want to add value to your life. I want to be a friend, a relationship, not just a professional guy who's a part of your life. Because if you're transparent with us, as I'm sure all of you are valuers, right? If your promoters and the companies which you value are not transparent with you, how can you do a very good job at it? You cannot. You'll try fishing for information. As long as I'm transparent with you, you're transparent with me, we'll be able to create good asset classes, good returns on a consistent basis. So going back and trying to answer your question, man, choose your wealth managers very, very carefully. Yes, I have a few pointers on the chat. I'll just very quickly try and address them. Uh, I think Mr. Pratyush had a question, how is HNI different from inflation risk, which we use in calculating risk-free rate? So we've just taken, this is a research which we've done at Anand Rathi, where we've looked at most places where an HNI would probably go and spend that money, which could again be travel, flight tickets, banquet hall, medical expenses. Because again, the age bracket at which we are, our parents are also getting old, so they will always have medical expenses. We might have medical expenses. So these are some of the average cost which we found across multiple cities, across multiple expenditure routes, and what could those inflation rates be. And in trying to calculate risk-free rate, probably you have to add a little bit of premium, an HNI inflation premium, because your basic inflation is about 6-7%, and we're just adding that 2-3% extra over it. That is the risk premium which can be added to it. Explain the right of government or legal authority on a personal savings account, fixed deposit, physical assets in case of any legal proceedings. So again, if you do not probably have a private trust or a will in place, if there is a legal action against you, all your asset classes will be attached. Everything which is under your PAN, where you're the first holder or the second holder, will probably get attached to it. But as soon as you have a private family trust in place, it's a separate PAN account. It's a separate entity where there's a managing trustee, there's a co-trustee, and there are different beneficiaries. If you are the managing trustee of that trust, you can never withdraw money directly from that trust. But if you have three beneficiaries, for example, if it's my trust, I'm Mr. X, my wife is Miss Y, and then we have three children, A, B, C. I could decide that, okay, say 50% of the money has to go to my wife, and the balance 50% is to be split in the three kids, right? If that was to be the scenario, I can never take money out of the trust. But the beneficiaries of the trust, my wife and my three kids, can take back that money. And if I need that money, they can always transfer it back to me, because immediate blood relation transfer is always going to be probably be free of cost. At least today it is free of cost, right? So you will never be able to use that money, but that money essentially is still yours. But it sits in a different PAN account, so it can never get attached to any legal proceedings for that.
I have a question here. Can I ask? Since you have touched up on the trust, private trust, it is relating to taxation. Can I ask?
Yes, sir, please go ahead.
Oh,
I'm sure
now,
you guys are the tax experts, but please.
I'm not a tax expert in terms of that private trust and individual tax planning. But
Right.
having said that, no, this is tinkering in my mind for last couple of weeks.
Right,
See,
sir.
now if you plan a trust,
Right.
so the trust is, beneficiaries are different. The trust, how this trust will be taxed? Is it like a OP, or is it the status of trust will that of an individual? Or in case if you see, because now the individuals are subject to tax at a higher rate of, I think it is at 47%.
Right.
Can we have this trust arrangement to structure the tax planning in such a way that that surcharge and other things are minimized?
Absolutely,
Do you have any
sir.
idea?
Absolutely, sir. Let me try and break this down first. So the 47% probably with the surcharge which we are paying is largely on all the income which we make, right?
Yes.
So as soon as you come to a wealth manager, if I'm trying to advise you, I will never be able to help you with your income tax, because that is the income which you're making. I will never be help you with your TDS also, because again, that's a tax deducted at source, nothing which we can do. What we can very well is capital gains taxes, because we'll be using our private family trust in trying to invest money. As soon as we invest money, all the profits which come back are capital gains. Now, because we only look at two asset classes, equity and debt, let's understand the tax numbers what apply to them. There are two concepts, long-term, short-term, for both equity and debt. For equity, my long-term taxation is 10%, short-term is 15%. For debt, it is 20% long-term with indexation and 30% short-term. So if I'm limiting my tax to a maximum of 30% only, right? And if I have a very good asset allocation to it, I can minimize my tax liability to as low as 13.5% only, sir. I don't have to pay 47% taxes on that, because that is not my income. That is just my capital gains. And we have an objective based doing wealth management where you don't have to change and chop your portfolio on a monthly or a bi-yearly horizon. What that allows is, if I'm not selling every now and then, if I'm not changing and chopping my portfolio, I'm not booking my capital gains. If I'm not booking my capital gains, there's no tax liability on that. Because it's not a fixed deposit, it's not a recurring deposit that I have to pay tax on accrued income. Or the day I sell is when I have to pay my taxes. And our objectives, our strategies are created over a 3-year, 5-year period. So I'm selling only once or twice in a 3-year, 5-year period, unless, of course, there's a liquidity need. So, of course, we can minimize the taxation to as low as 13-14%, because those will only be capital gains taxes in asset classes which we understand, and where my tax rate could be as low as 10% and as high as 30% only. So it'll never go to 47%.
So in one of my case, what happened? The dividend income is exceeding the 5 crores because of the portfolio that he is holding. So
Right.
he's not going to sell those shares for quite some time. So capital gains I can't plan. But what about this dividend? If I have a private trust wherein the beneficiaries are his family members, if I split that dividend between this private trust and this individual, if I can make it come down below the 5 crores or 2 crores threshold limit, can I make in such a way, because trust is a separate legal entity, it will tax of that will be different.
So I'm not very sure about it, but probably what we can do, there are multiple ways of reducing your tax liability as well. Because even if you're saying if it is breaching the threshold, there are multiple mechanisms in which, again, everything in the 4 walls of the law, which we can probably use to lower our tax liability a little. Again, that is something which we could, of course, discuss one-on-one so that I can understand the case a little better and then probably advise you on that. So if you're comfortable, why don't we do that? After the call, probably we could connect one-on-one, and I'll try and help you answer that question.
Sure. Thank you so much.
Thank you, sir. I'll just come back to answering questions in a little bit. I'll just try finishing some of the points on the PPT as well. Shilpa ma'am, please stop me whenever you have to make that important announcement at 8:30.
You finish your PPT, then I'll make announcement, then we'll take up question answers.
Sure, ma'am. Sure. So as we were speaking about asset allocations, right? We only have 4 asset classes to invest in. So if this was my allocation, if 50% of my money was lying in debt, 40% in real estate, nothing in equity, and 10% in gold, I did a comment on the chat box where someone said that, okay, yes, gold has delivered probably 20% returns in 30 years. But again, adjusting for my my INR depreciation and how the quantum has changed everything, probably our returns would probably not be that high. Of course, we would always have outliers in a sample, probably. So if you've been able to create 20x returns, absolutely beautiful. But largely what we've been able to see historically, this is the kind of return your portfolio would be delivering. Only 9.34, again, not beating my HNI inflation. If you make only small changes to my portfolio, look at it. My 50% debt has become 45%. Real estate 40 has become 35. And I've added only 10% equity to it. My return has jumped from 9.34 to about 14%. Only with a 10% allocation in equity. Again, I had a comment on the chat box where someone said that equity is volatile. Absolutely, it is volatile. Where else do you make money? We make money in volatile markets. That is when we buy well, we sell well, right? Because again, we've seen in the previous slides where equity, my mutual funds have delivered fantastic returns. They've become 500 times. 1 crore has become 400, 500, 600 in the period of 30 years. So if I had to choose any one of those funds, HDFC Flexi or Franklin India Prima Fund, this is the value which I would be sitting at today. And finally, if we do a little more tinkering, we see, and what is that tinkering again? If we've put into 2 other mutual funds, HDFC Flexi and Franklin India Prima were 2 examples. If instead we put into Franklin India Blue Chip or Nippon India Growth, we would have even better returns, right? Also, what having a wealth advisor allows you, because this is something which we keep hearing about. If you're invested in an asset class, please be invested for 15, 20 years, right? But that asset class could be correct. Where to put that money has to alter every now and then based on the flavor of the season. For example, 2020 is when we saw a lot of pharma companies doing very well. 2021, we saw them not doing so well. 2021 till now, we're seeing all IT companies not doing very well, India, abroad, everywhere, right? So we've still invested in equities, but we're probably not being investing in tech stocks right now or pharma stocks right now, right? So having a wealth advisor allows you to make those changes as you go along. You still invested for 15, 20 years, still in the same asset class, but some changing can be done. What can be seen from my portfolio 2 and portfolio 3? Two funds would have given me 13.83. The balance two would have taken it to as high as 15%. So choosing what we do is very, very important. Now that we've been speaking about returns for a while now, right? And this is what money management is about. But returns always come with expectation, right? Because we don't know what is going to happen in the future. We can only try and construct a portfolio so that we can participate in all kinds of market, when markets are rising, when markets are flat, when markets are falling. And this is not just equity markets. This could absolutely be any kind of market. There could only be three scenarios. But risk always comes with the word management as a in the end, because risk is subject to management. Right, as someone was again mentioning on the chat box that what do I think about US unlisted stocks or any unlisted stock for that matter. To answer that question, there's a lot of risk involved there, and risk does not come only in the terms of a default. Risk can be multiple kinds. There could be a liquidity risk. What does a liquidity risk mean? If you've bought an unlisted share, for example, before Zomato or Paytm went public, there was a lot of chatter that I want to buy Zomato stock, I want to buy Paytm stock before they go public because they're going to try and create a lot of money. What if those companies never went public? Who would you be able to offload these shares to? You will need someone to offload this to. You will need a buyer in place. But as soon as you don't have that, we suddenly have a liquidity risk in the ecosystem. We might not be able to sell it. Best example for that is look at, I'm not against real estate at all, so please don't feel that, but look at real estate for that matter. Whenever, if there's a liquidity need tomorrow, and even if we have a very good property with a very good appreciation in the last 15, 20 years, we cannot sell it immediately. We will not find a buyer immediately. The legal proceedings, the paperwork is going to take so much of time, right? So again, that has liquidity risk. The time I want my money, I cannot get that, right? And even when we speak about risk, we end up speaking about risk only in English, low, medium, high. And because we were talking about objectives a little while ago, if I have my objective in terms of English and not numbers, I can never monitor it. What could be very low risk for you could be very high risk for me. It is subjective in nature. So we put standard deviation, a basic statistical parameters on our portfolios, which we monitor on a quarterly basis to understand what is the risk on your portfolio, right? And while we talk about that, and I've spoken about return objectives of anywhere between 13% to 15, 16%, we also look at risk in terms of standard deviation, which comes to as low as 7.5%. And what does that 7.5% signify? Nifty in the last about 20 years, 22 years, has had a standard deviation of anywhere between 14% to 18%, depending on the horizon which we look at. What does that mean? I am creating similar returns to what Nifty is creating at half the risk. So my returns are only expectations in the future. I can plan for it. I can have asset allocations in place. I can choose my vehicles and then expect for a return. But as long as I've managed my risk, I know that even if for a specific year, if I've not got the returns which I want to be getting, at least my risks are managed. My money is not going anywhere. There's no credit risk in the system. Credit risk is defaults. Something which we had heard and seen during 2020, right when COVID had happened. In the month of April, 21st of April, is 6 debt schemes of Franklin Templeton went bust, and the Supreme Court ordered them not to, there cannot be any fresh investments or any redemptions. They had to lock up those funds. But because we had active visibility on all our wealth portfolios, we were managing risks very, very closely. On the 10th of April or the 11th of April, we took a call and all our investors ended up selling those funds. So we never got trapped into that bust phase. Coming back to Shilpa ma'am's question, that so there could be situations where probably a wealth manager missed telling you about exiting a Franklin fund back then. But if he was a good fund manager, if he was on top of most things, he would have avoided that scenario for you. So again, returns comes with expectations, but risk is something which can be managed, right? Now, again, coming back to trusts and wills, the safety nets. There again, these are some things which we've already discussed, but I'll just touch upon them very, very briefly. Business risk, right? As professionals, or maybe promoters, some people who you work with very, very closely. They're promoters in the company. They're signing a bunch of documents on a daily basis. They're signing financial documents on a daily basis. You never know what can get attached to you. And if that had to happen, a private family trust will help you protect your wealth. None of us have any negative intentions, wrong intentions in place. But if something wrong had to happen, we can't plan for it, or we can't do anything if we don't have a plan in place. So as soon as we have a private family trust in place, we can help ourselves from business risks also and professional risks also. And the third part, which is very, very touchy, family dispute. No one plans for it. But if you have this in place right from day one, okay, child one, child two, child three, this is the way you're going to be allocated. They know it since the time things start. If those are equal, best. If those are unequal, they know why is that and what is there. So if something had to happen 5 years, 10 years down the line, at least there's no dispute in the family. Right. So private family trust and a will helps you plan for all these three. Right. And efficient and smooth transition of wealth is also very, very important. This is what wills allow you to do. Because again, I know whatever wealth I have, I know who that has to go to. If I have done all the groundwork, my future generation does not have to worry about that. As I was mentioning about estate duty, something as high as 40% to 90% back in the 1980s. It's been abolished since then. But Mr. Arun Jaitley in 2018, as probably his last address as the finance minister, also touched upon wealth tax or inheritance tax or estate duty, whatever you want to call it. Among most developed countries, only 2 countries don't have this as of today, China and India. And we are very, very confident it will come back. The day it comes back, 30-40% of our wealth will be taken away. Anyway, we are paying hefty taxes. Sir was mentioning 47% taxes with surcharge, etc. Right? Plus now we have direct taxes also, indirect taxes also, GST on everything, income tax are rising. And as soon as we have this estate duty also, whatever money we've saved, that will also go away. We don't want to be in a situation like that. So having, again, a private family trust helps us in multiple methods. Plus, companies have this concept, right? Basic accounting term, which I had studied back in class 11, a going concern concept, right? Companies always go on. Similarly, your wealth and your family will also always go on. It's also a going concern. You might not be there to witness it, but your future generation will be there to witness it. So unless the money flows very seamlessly, that objective again might get defeated. So we've had 2 vehicles to do this, wills and private families trust, and that's it. That's it from my end. So this is just a screenshot, which probably you can take, or a PPT, which I can share with the group later on. Try spending some time on this. Try understanding where are you currently invested, what could be a return potential as we go along. And again, if this is something which you are comfortable with, and because you work with a lot of valuers, a lot of promoters, a lot of companies, you might, because again, you would also probably want to give a very holistic service or a holistic offering to your clients as well. If someone is interested, you could of course take this to them, understand what are they invested in, what can the return potential look like. And if you're comfortable, please always feel free to come back to me. We'll help you analyze, because again, as I was mentioning, everything is non-obligatory in nature. Just because you've shared your financials, or you can in fact share these numbers also in terms of percentage. There might be situations where someone's not comfortable sharing numbers. Don't give me numbers, give me at least percentages, so that at least I can reallocate everything to a number of 100 and understand 3 years, 5 years, 10 years down the line, what does my portfolio stand to deliver. And if there are any cosmetic changes, because it's a very eye-opening activity. We avoid doing it, but the day we do it, we'll understand where this money is and what can my return potential be. Once we've done that, we'll be very, very happy to analyze it for you, come back to you with our suggestions, our comments. And if you think it makes sense, of course, we take the relationship forward, you or the promoters you work with. But if you think it does not make sense, this guy just wasted my Saturday morning on a long weekend, no problem. I'll be at least try and answer your questions for that matter, at least. So that's it from my end. Very happy to be answering any questions.
Shreyan, this is Subbarao. See, can you elaborate that? Okay, see,
Subbarao, just 1 second. We will make our announcements. Then
okay. Okay, because Shreyan is going to be there afterwards also, you mean?
Yeah.
Okay,
I'm there as long as
5 minutes our announcements will be.
Yeah, no issues. Okay, thank you.
I request Mr. Subbarao to go ahead and make the announcement.
Yeah. Thank you, Shilpa. I think we are getting a lot of calls from our members to have a physical session.
Sure.
To have a physical session. We had pre-COVID 2019 August, Bangalore Valuer Association conducted residential program on valuation insights. Now, fortunately, now we are post-COVID, and we had good timing now. And we are going to have a residential program on 27th and 28th August 2022 in Bangalore, the Golden Palms Hotel and Spa off Tumkur Road, where we are going to meet Saturday morning 8 a.m. Till Sunday 6 p.m. We are going to have sessions. The first day we are going to have 2 technical sections and team
That
building.
I'll take care. That schedule.
Yeah, okay. That is done. And also like it will be like an interactive session, not like any seminars or webinars type. Okay, now we need to even all members can forward their questions through Google link, and we are going to have discussions like what are the valuation challenges we are having day-to-day life, and we are going to give 8 CP hours also. And this pricing is like 9,000 rupees for BVA members and 12,000 for non-BVA members, and accommodation is on sharing basis. Now, this is going to be like a discussion on valuation challenges more, and it is like interactive session. Now, I would like to Shilpa to discuss more on how we are going to plan 2 days.
Yeah. Friends, we felt since COVID has, we are not hearing much about COVID, so it's high time that we all meet up. And this request was there from a very long time, to personally meeting up. 1 second. Yeah, actually, the plan is basically to have sufficient time for us to network and to meet up and to personally, interact as to how I'm taking up any particular valuation assignment and how any others are taking up the valuation assignment. What is the perspective or the view of others? Okay, now, till now, how the sessions have been at BVA is the speaker says and then we all listen. But then there is no right way or wrong way of doing things. I would like to know what my peers are doing it. And they also would like to know how I'm doing it. So that session, 2-day session is basically day 1 is with a normal speaker session. And then day 2 is all about group case study. And I invite all of you to give me the questions so that all of the questions can be collated and discussed and debated in on day 2, that is 28 August 2022. This group case study, we will have panelists, expert panelists, and then the participants are being divided group wise depending upon their seating arrangement. So a table, normally a table wise scenario of seating arrangement, we have 5 or 6 on each table. So if I'm assuming a crowd of 50 members, so we have 10 tables and 10 groups. So each group, 2 or 3 groups will be given 1 question. Okay, a question will be given, a timer will be set, 5 minutes or 6 minutes, and the groups will discuss. And the group representative, which will be again rotating, the group representative will say will say it aloud the answer of that particular question. Second group also will be given a question, task of putting their points, and all other groups can add on to it if they want to counter it or they don't agree with it. That is also open. And then finally, the panelist will have a conclusive talk on that particular topic. That topic could be Excel based or laptop based, so that most of our time we'll be struggling on valuation workings on Excel itself. So few of them theory based, discussion based, few of them Excel tools. That Excel tools will help you to day-to-day valuation workings. Most of you could be using very good Excel functionalities, but others may or could have find difficulty. So we are trying to equip even the freshers who are not so good in Excel functionalities, those complex functions, that we are trying to, together we all would be a different person maybe on August 28th evening. And after 4:30, yeah, that will be the concluding session on the second day. And August 24th, I'm actually requesting the speakers not in, any particular topic I don't want to choose. I want them to share their experiences. They are from Big Four, technical speaker 1 and technical, session speaker 2, morning and evening session. So the whole process is about sharing of our experience. The theme, the Manthan is, as you all know, it's like, the churning of Amrit. Okay. All of us, can take the taste of Amrit only when all of us actively participate in this program. It's my humble request, please make use of this opportunity, and whatever we are charging is basically to make it's a 5-star accommodation And all the, right from the breakfast in the morning till the snack in the second day evening is being arranged for. Most of this, almost 90 to 95% of the fee what we are collecting will go away straight for the hotel. Okay, there is nothing like BVA will get out of this as a committee. So that's my humble request to make use of this opportunity and make it an interactive session. And we are also planning first day evening a fun activity. Okay, just to have that team building effort. And one more request is, few of the participants may not be interested to have the credit hour certificate. That is why this is being given as an option. If you would like to opt for the certificate, 100 rupees for 1 hour, 8 hours which can be provided. That will have to be separately paid for at the counter on day 1. And then we will be giving you CEP certificates later. I request the participants to ask any questions if they have on the residential program.
Yeah, and why we are going to conduct in the month of August, because as you know that as CA and CS will be busy in September and October, because we don't want to again go ahead more, okay, because otherwise people will not be joined. That is the reason, okay, we're arranging in month of August. I know it is very short time. Please make it available to attend this session.
So what will the topics on what will the main topics that will be covered in today's citizen program?
Session 1 on the day 1. Okay, it will be Mr. Amit Raj from PwC. Final confirmation is yet to receive. That is why in the flyer you will not have their names of the speakers. Okay, flyer will be released today. Basically, it will be the practical challenges which they would have faced, because PwC and EY, they get a very good, what do I say, creamy layer of work. So whatever challenges they are facing in their day-to-day valuation activities will be shared by the speakers. Second technical session number 2 also same. And the next day, 28th August, it will be interactive. As I said, it's a group case study. Few Excel, few Word, all of that together. I hope I was able to answer your point.
Yes. But that will also include the ESOP valuation, like
See, Mr. Sanjay, my humble request to you is please post your questions. In the flyer, we will be mentioning the mail ID and all. Please post your questions so that, it is all for us. We are having this session
Definitely.
Help ourselves.
Definitely.
So I request you to put numbers also in your questions. Like you want a case analysis, like you don't want a theory to be discussed and you want the actually how the theory is impacting the valuation.
Correct.
So it can come with numbers also. And, this program can be a success only if all of us together participate here while giving questions to us and there while interacting the sessions. Your problem could be my problem either in the past or in the future. All of us are sailing in the same boat. So let's help each other and grow each other.
Okay, thank you. Thank you.
Yeah, any other suggestions you have, please come back to me, reach out to me or Mr. Subbarao and even admin Vijaya. Okay, please reach out to us for any of your suggestions. This program is basically for us. How we want to change it or how we want to make use of it, it's left to us. So please feel free on this. Subbarao, on registration last date.
Yeah, registration last date is 20th August. Please register yourself. Okay, it is like a first serve first basis, and once registrations are closed and you cannot join, because again we have to provide accommodation, all those things. Please join yourself immediately.
On the spot registrations, we are not encouraging because we want to manage, we want to book the rooms. If rooms are not available, only thing is, we don't know how to accommodate. The whole fun is lost if you are not available at the venue.
Correct.
So that's why, we have to book the hotel rooms in advance, and 1 week advance time we have to give to the hotel. That is why 20 August will be the last date for accepting registrations. The flyer will be circulated today itself, soon after the program ends. And outstation participants, I request you to book your, flight or any other mode of transport which you would like to drive down.
I have help from Varanasi long distance. That's why question I said.
Yeah. Please make it an opportunity. It's a wonderful opportunity that we all meet each other. We have been interacting online only. I would like to meet all of you in person, talk to all of you. I have been just hearing to you now. I would like to meet you in person. And that will be a real opportunity, Now, or else, where else we get this opportunity? ICAI, ICSI, I don't think they believe in, actual interacting. Many times we are not able to speak in those kind of webinars.
Yeah.
So this is one wonderful, even PwC, EY, it's mostly an open session wherein, they can interact. Like they are very good. The way the capital structuring is made by these big fours, it's hardly difficult for me as a valuer to understand and decipher the meaning of the structuring, like impact. So that is why first topic, if I'm able to reach out to the speakers, which I have thought, it could be one session could be on structuring, how they structure so that I can understand it better and value the organization, which has a complex structuring pattern. Yes, anyone would like to go ahead on this residential thing? Or shall we move on to Mr. Shreyan's?
Yeah, any questions from the members about this session, residential program?
Please pass it on to your friends also.
Yes.
So that, all the valuation related professionals can make use of this wonderful opportunity. Limited seats are available, so this quick registration process. And Subra, would you like to make an articles?
Yeah, even we want to circulate newsletter also to a brochure type. I request any members, you have any articles, okay, we will publish in the newsletter. Please provide before 20th August, you can provide that articles on valuation topic.
It's a wonderful opportunity that, your article will be read among the fellow valuation professionals. And in case you have any access to any of the sponsors, please help us, to reach out to the sponsors. That will be really helpful, to get ourselves a better opportunity. Maybe if we are able to get more surplus because of the sponsors, we will soon make out, roll out one more such program. Okay. Some workshops or anything we can plan if we are able to generate surplus out of this. Okay. And now I'll move on to today's presentation. Friends, today's presentation is basically to, sometime, we are more interested in our own professional work that we forget to have this investment perspective. Okay. We may forget that, or we may sideline that, okay, maybe this is not the right time to invest. Or sometimes, it's not actively in our mind that we have to invest. The way we are excited about taking up our professional assignments and we are so busy in this. So we may lose interest somewhere on this very important thing of wealth management and wealth investment. That is why just this, introduction session, and anyone who is interested can reach out personally to Mr. Shreyan. Okay. That is why we are not discussing any of their charges or anything that and all we are not discussing here. It is personal. If you are interested, you can reach out to Shreyan. This session is basically to clear any doubts you have on, wealth creation, wealth management, any of the tips and insights, one or two, if we can make use of it and come out of our shell, the professional busyness shell, then nothing like it. And Mr. Shreyan, one request is, say, for example, I have 1 lakh or 2 lakh at my disposal right now. And Monday morning, the browsers are open. You have to tell us. We are in the range of, say, 30 to 40 years of age and our long-term investment. We will not leave you without giving us investment tips. Monday morning, whoever has it, we have to invest it on a thing which you're guiding us.
Absolutely, ma'am. So let me try and answer that question in the end so that all of you please go back with happy faces, because I've taken a more time on a Saturday morning. So
Yes,
I'll definitely answer that question, but as we end the session, ma'am. And if anyone else has any questions, please feel free. I'm here as long as you want me to be. Very happy to be answering your questions.
Just one small thing. I don't know, I know you're not a legal expert, but then suppose a property is there in the name of, say, Mr. X, and property is jointly held in the name of Mrs. X. Mr. X and Mrs. X jointly hold it, and Mr. X is no more. So will that, normally if nothing is mentioned, it is supposed to be 50-50. Okay.
Right.
So will that property also go to their parents? Because parents, spouse, and then children are supposed to be the category 1 legal heads, right?
Right. I think I'm not, again, as you mentioned, I'm not a legal expert, so might not be able to give you the best advice. But what at least happens in the asset classes where we invest, if the first holder is no more, everything, then the second holder becomes 100% owner for that.
Oh,
And
that
whoever is the nominee for that, so again, as you were mentioning, if Mr. X has passed away, the 100% owner is now Mrs. X. And if the nominees were the three children A, B, C, the nominees still remain the same. So if Mrs. X had also had to pass away, then the three legal heirs become the owners for that.
And
And
suppose a married woman
yeah.
has any property, will her parents also be eligible for that? Because normally, it's mother, parents, spouse, and kids. Even for married women like that, any idea?
Legal heirs?
Yeah. Who is
Yeah,
the
legal
first
is
category legal heir for a married woman?
not sure, ma'am. This is I'm not sure.
Okay, sorry for bothering you on an unrelated
No
question.
problem. No problem. Mr. AM had a question: trust income to be taxed in the hands of beneficiaries. So how this works is now trust is a separate PAN account which works like an individual, right? All the taxes are at individual rates. So whatever capital gains will be there, if you invested 100 rupees today, 20 years later, that 100 has grown to say 400, 500. That 500 rupees is out of, if you subtract 100, you get your profits. All your capital gains are paid. And only once your capital gains are paid by the trust does the money go to the beneficiaries. So beneficiaries don't have to pay any tax. That is how it helps us protect against the wealth tax or the inheritance tax.
Right. So let me just ask this, since you
Yes,
are
sir.
familiar with, you've done this probably by way of structuring.
Right.
Now, when a trust is there, the dividend
Right.
income, this was a
Right.
question which Gangadhar had.
Right.
The
Right.
dividend income which comes in the name of the trust actually goes and gets taxed in the hands of the beneficiary. Okay.
Okay. Okay.
Right. So I'm assuming this is how it happens because you are familiar with it. You'll be able to
Right.
throw some light on it. Now, therefore, whatever is the income which is there in the trust is not taxed in the hands of trust, but will be taxed in the hands of the beneficiary. It will add it
That's
to the
all.
beneficiary's PAN and tax there.
That's only if it's the dividend income, probably, sir. But everything which you hold and sell, not. Everything that will be taxed in the hands of the trust. Dividend income,
Right.
probably if it's directly going to the beneficiary, yes.
Yeah. So now the issue which we face when setting up the trust is the shares are, let me say that the shares are held in my name, and therefore
Right.
the dividend income is coming into my name, but I've actually
Right.
created a trust.
Right.
And I've not been able to transfer the shares to the trust. I'm the trustee in the trust also. Let's assume that's what it is. I've not been able to transfer the shares to the trust. What will be the tax implication of trying to transfer the shares into the hands of the trust? That's the question. Because you've set it up,
Yes,
you
sir.
probably know.
Right, sir. So because again, you will be transferring from one DMAT to the other DMAT, from your DMAT to the trust's DMAT. So there's something called a DIS, a delivery instruction slip, which works like a checkbook. So you key in your numbers there, submit it to your repository, and the shares will be transferred. So for you, it will be a gift. If you're giving it to your trust, which is own private family trust, it will just be a gift, right? So you neither will you be taxed on it, neither will the trust be taxed on it. But the day the trust has to sell it, say you bought it at 100 rupees, the day you're transferring it to the trust, it is at 150 rupees. And the day the trust sells it sells it at 200 rupees. The tax will be on the difference of the initial purchase of 100, not the transfer value.
So there will be some off-market transfer fee, I'm guessing.
Off-market. Yeah, not fees, not necessarily, but the process will be off-market transfer. It'll be a very basic DMAT charges, sir. Not very, very high. Something below 200 probably. Not very
right.
high.
And Anand Rathi is able to set up a private family trust DMAT account
Absolutely.
easily, I hope.
Absolutely, sir. Yes, sir. We have a very, very strong legal team who helps us do this. And of course, we are in the creating of setting up DMAT accounts.
Okay. Now, the next question is, you've talked of trust plus something else, some other.
Will, sir. Yeah.
Or great. You said, which was the other one? A private limited company or?
Will, sir. Will.
Will. Okay.
Wills
now,
and
why not
trusts.
a private limited company or an LLP? See, an LLP is extremely easy to create. So why don't
Right,
we?
sir.
And it has existence which is perpetual. So why don't we transfer it to an LLP and create continuity there to avoid estate duties? Why are you not using that as a estate planning mechanism?
Oh, I'm not very, very confident. Why don't we use LLP, sir? But wills and trust have worked very well for us. I think this is largely because will is something which can be reiterated and beneficiaries can be chopped and changed, or corpus can be chopped and changed. I'm unsure how exactly does an LLP work, sir. So might not be able to answer that very, very well. But let me read upon this, ask my fellow legal experts, and come back to you on this, sir.
I can throw some light on this, because LLP being separate legal entity, probably from the tax perspective, not from any other wealth management perspective. See, in terms of the definition of transfer is not satisfied when you transfer. See, there are exceptions to transfer, right? If you transfer the assets to LLP being it will detract capital gains tax, and also the 56(2)(10) will also be invoked if you transfer the asset below the fair market value. If the fair market value of the share or a capital asset is increased from that of a cost of the acquisition, the differential will be taxable in the hands of the LLP if it is below the tax, fair market value, or otherwise, if it is at the fair market value, the difference is taxable in the hands of the transferor, that is the individual, as capital gains tax. So you
Right.
don't structure LLP as a tax planning vehicle.
Yeah, because when you're
Even
trying to
the
create,
same is the case with the private limited.
so even though you're trying to create the LLP as, let us say, the mechanism, and you're basically saying that I'm contributing the capital by way of shares into the LLP, still,
Capital contribution you can do that, but the act is silent about application of 56(2)(10) in case of capital contribution received by an LLP. So
right.
there are chances that it will detract 56(2)(10).
Got it. So then, Shreyan, also from your viewpoint, see, suppose we just contribute rather than creating investments in our own names. I mean, going by your point again.
Right.
Suppose we just create the capital in the LLP, okay, and we invest through the LLP. Is that not a better mechanism?
Okay, so here your LLP will be working like a company, right? So all your taxes will again be company based, as compared to trust, which will be working as an individual. Will you cannot invest with, trust you can invest with, which will work like an individual. That is one benefit, sir. And again, I might not know a lot of details on LLPs. I don't want to give you incorrect details on that. But LLPs will work as a company versus trust working as an individual. So your capital gains taxes also get reduced like that.
Yeah,
Sir,
the tax rate is higher
on
for an LLP.
the question of on the recent question, another point that will go against this LLP theory is, say LLP is my investment. Let's say in the earlier version, when we were creating trust, nobody can touch the property or estate of that trust. Whereas in LLP, because it will be an investment, in case something goes wrong, like in the case of Vijay Mallya, had it been an LLP, and all the investment made by Vijay Mallya into that LLP, they would have been attached by now, and everything, that entire wealth created in LLP, that also would have gone to the bankers. That was my. I have one question, but I'll ask it afterwards. That current questions get exhausted. Please carry on, sir. You were asking something.
Yeah, so that's a good point that you made. Thank you for that, Rajiv ji. So now, therefore, coming back to your point, you're saying that, see, let's say, for instance, today the beneficiary is X, and in the trust. So after that, we want to create Y and Z as the beneficiaries. I think what you're saying, Shreyan, is that we can change the beneficiaries without impacting the capital gains situation of the trust. Is that right? I mean, would that hold?
So beneficiaries would not be able to change unless someone had to probably pass away, because this is something which you have set up today, which is irrevocable in nature for the next 20 years, right? So your wills is where you can keep changing your beneficiaries and your allocation, but trust is something which you have already in place. So either first you have to dilute that specific trust and then set up a new trust to have new beneficiaries there, because that is something which you've already set up at day one for the next 20-25 years, whatever horizon you decide for at day one. So you might not be able to add beneficiaries to your trust, but wills you can. Wills you can keep changing and chopping.
Okay, got it. Rajiv ji, carry on with your question. I'll come back.
Yeah.
I have other things.
Thank you, sir. I had because in your example you use the investment by way of say shares and the parking or divesting FD into this private trust. So how about parking the real estate also into this trust, wherein there could be some real estates which are yielding your rental incomes because of, let's say, their commercial nature or otherwise. So is that also possible? And from that rental incomes, you can mention it within the trust that these rental incomes can be used for these purposes unless distributed, like
Yes.
acquisition of more shares and things like that.
Right, sir. So this is absolutely up to your discretion while you're trying to create that trust, because you will have something called a board of resolution, a letter of intent, all of that. So if you allow your trust to be doing those activities, your trust can absolutely do those activities, because it works like absolutely like an individual. It has its own PAN account, its own bank account, etc. Right. So as soon as it starts working like an individual, you're free to invest in whatever asset class you like. Real estate also, for that matter, can be invested. All the rental income which is coming, that can be a clause in your board of resolution or your letter of intent, that whatever rental income comes, either this can immediately be invested or it can be transferred to the beneficiary as soon as it comes. That's up to your discretion, sir. All the terms and conditions about which asset classes to invest in also lies with you. So what we found in the last 15 years while we work with our investors and families, so some families have a charitable trust only. Some have a private family trust. So a charitable trust will probably be doing only charity. That is the clauses which they have. Some private family trust will not allow them to invest in a specific vehicle. Say they cannot invest in stocks directly. So those clauses are absolutely up to you, because those will be registered with the codes of the specific state. And every time you make an investment, that works as a proof, because whoever is selling that to you wants to first check that they don't get into the legal ambit of that. So it's, again, to answer your question, it's absolutely up to your discretion. It can be done. And the clauses which you decide will work eventually.
And running there too is how good or bad HUF versus this private trust.
Right. So HUF, again, it works as an individual account. You have a separate PAN account, everything. You can reduce your tax liability. But again, beneficiaries is because as soon as the Karta passes away, there's where the problem probably starts, right? Versus when you have a managing trustee in place, if the managing trustee had to pass away, he would have a legal heir in place who is then supposed to take over. And he would have already set these out as clauses that if something had to happen to me, who's going to be the first controller or the second controller as you go along. Generally, that is the second trustee which you have in place, and they take it over from there.
Thank you.
Thank you for your question, sir.
I'm done. Thank you.
Sir,
Right.
sir, can the
Yes.
beneficiaries mortgage the property to raise finances?
The trust can, sir.
Trust can. Okay.
Right. So this is something, again, which we use very, very actively, especially when markets are super low, right? When markets went to 15,000 levels, what a couple of our trusts did is, so you have some assets in your name. It could be mutual funds, it could be stocks, it could be real estate, whatever. And then you can always get a loan against security. So for mutual funds, that is called loan against security. For properties, you can get loan against property. Now that depends whichever NBFC you're working with. What kind of haircut do they allow on that? For example, Anand Rathi has a private wealth management division and also an NBFC. So what happens is all our investors who want to get this done, they take a loan against securities from our NBFC at 50% haircut on equity. On real estate, which is properties, again, that is a 50% haircut. So if you have 100 rupees in the specific property, you've pledged that to the NBFC and they will give you, say, 50 rupees back as loan at whatever interest rates is agreed at that point. So of course it can. Your beneficiary cannot, but the name of the owner has to be the family trust.
Thank you, sir.
Right. There was also a question, in fact, not necessarily a question, is that gold was 200 per gram in 1990 and today it is 5K. Gold is given 20 times return minimum in 30 years. Right. So very quickly, I was just working on my Excel to look at it. So this is what, sir. If 30 years ago, if this was 100 rupees, today if it is 20x, my annualized return is only 9.61%, sir. Right. Even, just a second, I'm unable to edit right now. Just a second.
Okay, while you're on the topic of gold,
Right.
would you prefer SGB to holding gold?
Index fund, sir?
No, SGB, that is sovereign gold bonds.
Absolutely, sir. Absolutely. Because it gives you liquidity. Today, when you try and buy gold or sell gold, you will always be at the wrong end of it because you'll be buying higher and selling lower. An SGB does not allow you to do that. It gives you fixed returns. Plus, it's very, very easily liquidable. So please don't hold hard
Okay,
gold.
so buy from the
Please hold
secondary
something.
market or buy in the primary issue? What is the suggestion that you have?
You can buy from the secondary markets also, but it's absolutely, there's no difference. You can buy the way you like, absolutely. Because
And
ultimately
the
your conditions still remain the
tax
same.
incidence is the same, meaning that I get
Right,
all
sir.
the tax
You know.
benefits in the secondary market purchase
Right.
also.
Right, because it's still in your name. That's right.
Meaning that when it is, the capital gains is not taxable.
Right.
Right?
Right, sir.
So, okay. So I have one question. If you're done with your gold example, can I ask that question?
Okay, so very quickly, I'll just show that because I could not. So even if it's become 20x, that's only 9.6% returns on an annualized basis. If it's 30x, even then it's just 11%. Right. So of course, it has probably delivered 30x to in the last 20x in the last 30 years. Even if it's 30x, it's still 10-11% only. So that is what we have to see, like not multiples, but probably annualized returns. But fair points, that gold is a good hedge against most whenever the markets have to fall down. But maybe not that. Definitely have to good some allocation in the portfolio, but not a lot. That's my answer probably to your question. Yes, sir, you had a question.
Okay, so this question is about short-term liquidity. See, typically short-term liquidity, we just put money into, let us say, liquid mutual funds, which
Right,
give a return which is between 3% to 4%.
Right,
now,
sir.
currently the rate of interest which is there on treasury bills, 91 days is 5.54% and 180 days is at 5.9% approximately, which is higher than the 1-year rate of interest on bank fixed deposits also. So, is this a preferable investment to liquid mutual funds is the question.
Absolutely. So even in the liquid category, so there are multiple categories. Something called a short duration, something called an ultra short duration, something called a money market. Each of them come with different kind of exit loads. It's largely maximum 7 days, where you're charged very, very minimal costs if you redeem within the first 7 days. So yes, these are better returns as compared to liquid funds, because liquid funds will only give you 3.5% on an annualized basis, versus a short term, ultra short term, or a money market instrument. Again, all liquid mutual funds can give you as high as 5.8, 5.9%. So absolutely, that's a much better.
Yeah. So then the question is that why would you do it through a wealth manager? Because then, see, the charges of the wealth manager on, let's say, treasury bills takes away almost about, let us say, out of 5.5%, the treasury manager will, when the wealth manager will take away, let's say 0.25 or something, some percentage he will take away. Okay. So is it not better to do it directly?
Right, sir. So 2 legs to it. Your expenses depend on, of course, who you are working with. Number one. Second, having a wealth manager, even if that person takes away that 25 bips out of your returns, for example, very hypothetically, if they actually do that, at least they're actively advising you on that. They have active visibility on your portfolio, and they can recommend what has to be done. I will shift this example to equity a little bit, because that is something which we do a little more actively. A lot of our investors do have this question: why should I choose you as my wealth manager and do regular plan as compared to a direct plan? Because again, as you were mentioning, the expenses, right? It could be anywhere between 25 paisa to 60 paisa on your 100 rupees. If that had to happen, and if I can create extra returns for you as compared to whatever everything else is doing, say in equity markets, if Nifty is delivering 12% and my model portfolio is delivering 15% return, if I can give you that 3 extra percent return with that 25, 30, 40 extra bips, 25, 30 paisa extra, at least I'm making your investment free for so many years. If I can create 3% extra returns for, say, a 40 paisa extra cost, I'm covering 7 years of your expenses, right?
Okay.
You get active advisory on this.
You made your point. Okay. Now, what is your thing about the maturity cycle? Like, for instance, let's say treasury bills, 30 days, whatever, 3 months. So, what is your suggestion on the maturity of the portfolio? Meaning that should we go into, let us say, government bonds, which are having maturity of 5 years, 10 years? What's your suggestion about this? How do you manage debt in this manner? See, you gave us the high-level asset allocation, but how about the maturity?
Right, sir. So debt should ideally be for 5 years. Right now, given the scenarios, the global scenarios where we are, where there's a liquidity push and a liquidity crunch is being trying to done, Indian government bonds today are delivering anywhere between 7 to 7.5%. Now, for us individuals to buy government bonds directly could be a little difficult based on the capital requirements for that. So that also we invest through mutual funds again a professional who's doing it. And if as soon as you invest money there for a 5-year period in government securities, either 100% with the center or the 100% with the state, you have zero credit risk because the government will always pay. And 5 years is delivering about 7.5%, anywhere between 7.3 to 7.5% returns today, as long as you hold them till maturity. Because in between, as whenever there are interest rate fluctuations, there will be a mark to market, and you might see different valuations. At times it could get negative, at times, of course, it could give you returns. But as long as you hold them till, say, a 5-year period, 2027 for this example, you'll make about 7.4, 7.5% returns.
Is that advisable when inflation is going up and yields on government bonds itself is going up right now?
Yes, because you can inflation is also coming back, right? Because we did go high, but now RBI has estimates that it will start coming down, and by the end of the financial year, we'll be close to 6.7%. So we will not be very, very high, which is tapering down from the 8% which we had a couple of months ago. So inflation is being taken into control. It is being addressed. So not to worry a lot, sir. And again, it largely depends on your overall asset allocation. If you already have.
So let
Yes,
me
sir.
just ask you then, Shreyan. See, because
Yes,
you guys are experts in this, no? See, what you
Right, sir.
play on is, let us say, the maturity of
Right.
debt instruments, let's say. Now, is
Right.
there a way in which you can bring down the maturity of debt instruments when inflation is likely to go up? What do you do? Meaning that if you
right.
bring down the maturity of debt instruments, basically the inflation risk is reduced, the yield
Correct.
risk is reduced,
Correct.
right? So how do you handle
Right.
that?
Right. For that, we have a different instrument, which is called a market-linked debentures. You don't have to necessarily invest in a debt instrument then. You get equity exposure, but that starts working like a debt vehicle for you. Because in scenarios like this, when my debt market is a little uncertain based on inflation, interest rates, both, then we gradually participate a little bit in equity as well. Just allow me to give you an example. The equity requirement for that is if markets move up by, in the next 3.5 years, if market moves up by 12% absolute only, you make 50% returns, right? Which turns out to be 3.4% on an annualized basis for you to make about 13% on an annualized basis. This works. This is called a market-linked debenture. This works like an equity vehicle. It is taxed like a debt vehicle. This is where I can remove my time horizon. This is where I can remove the inflation picture completely. But if I still had to invest in a debt vehicle, probably I'll stick with a 5-year government security, which is indirectly invested through mutual funds. But it also largely depends on your current asset allocation and how long are we looking to hold that. Because while we were speaking about liquid funds and money market funds initially, if I'm looking to hold it for only 3 to 6 months, I'll probably invest in money markets and not even liquid funds, just money market or ultra short duration funds. But if I'm comfortable holding them for the next 3, 4, 5 years, as compared to what we put money in fixed deposits for, if I do that, a 7.5% return on government securities is as good as a 10% return on fixed deposit post taxes.
Right, got it. If there are others, they can ask the questions. Please chip in at any point because I have a few more questions. Okay, so my question now is that on foreign exchange, no? See, on foreign exchange, you have not mentioned forex as a part of your portfolio. Okay, so what is the exposure and how do we get the exposure in our wealth portfolio to foreign currency? Because let's say if we look back at 2014, the dollar rate was, let's say, 42 rupees. Today, it's at close to 80 rupees, let's say. So over a period of 7 years, you've had it doubling, and it also gives you some protection. Okay. So what is your view on foreign exchange and how do we hold it?
Right, sir. So I'll just go back to the initial objectives which we had in mind, right? Because this is an asset class which will be volatile, which is something which we probably cannot predict. And Anand Rathi's approach to doing wealth management is extremely uncomplicated. That is the precise reason we don't dabble with very, very complicated asset classes or even asset classes which we think we don't have a lot of understanding of. Forex is one of those, sir. That is the reason we only do equity and debt, because it is uncomplicated. It allows us to meet our objectives. So no
Okay.
forex in our portfolios. The only foreign exposure which we have is through a couple of specific funds which invest a little bit of their money in some of the US tech stocks, FANG, etc. But that's very, very small on a portfolio level. But yes, we
Yeah,
do
but
have
at the
some
portfolio
exposure.
level, like for instance, if you just
Right.
look at what Damodaran says, for instance,
Right.
Damodaran, just quoting as a general example, it's not necessary
Yes.
that you follow whatever he says. His
Yeah.
approach is, let us say, to invest in the Indian market through the index, let's say,
Right.
which gives him the
Right.
exposure to the Indian market. So
Right.
as a wealth manager, do you recommend investing into the US index to give you some degree of risk reduction as compared to what is the exposure we have to equities in the Indian market?
Right. Risk reduction might not happen necessarily. It's a very very aspirational idea to probably put money in a very, very developed market like the US and be sure that probably there will not be a lot of volatility. But look at the last 12-15 months return, especially for US tech stocks or even NASDAQ indexes for that matter, even China funds for that matter. They've not done very, very well. So again, going back to my objective. So that is the reason creating an objective is very, very critical. If I know I can create that 13 to 15% returns consistently on an annualized basis, I don't need to complicate it too much for myself, right? Because these are very, very interesting ideas which we've also worked around, but we've realized getting consistent returns because we don't understand those markets very, very well, right? We know 10, 12 companies, all the ADRs which is listed there, but probably not a lot more about what could those returns be. Instead, have an Indian mutual fund which partly puts their money in US funds and have some exposure there, versus directly investing 100% of that mutual fund into a security. For example, I'll give you Motilal Oswal NASDAQ returns over the last 12 months. It's not done very, very well. And those are laggards in the portfolio. I'm sure it will come back at some point because equity always does bounce back. But India as a market is much, much more poised to deliver those returns with much lesser risk. Because we talk about risk, we look at volatility. But volatility is where returns are made, sir. Right? We saw markets falling from 18,500 to 15,000, but we've again come back to 17,500.
So let
Equity
me
markets
give
will
you,
bounce back. Yes.
let me give you a further reason why. See, many of us, I think that on this call also, I'm sure that there are people who are having family who are in the US.
Right. Absolutely.
So our issue over a period of time, okay, is that the wealth needs to actually transfer into the US at some point,
Right.
let's assume.
Right.
So therefore,
Right.
what is your approach towards handling wealth in this manner? Where, see, the other part of it is that today, let us say there is a risk which is there based upon the exchange rate, in the sense that if the exchange rate changes dramatically,
Right.
then our wealth in dollar terms comes down significantly.
Absolutely. Absolutely.
So how do you protect against this risk, and how do you ensure wealth transfer
Right.
overseas?
Right. So on average, we've seen Indian rupee depreciation of 4-5% per year. If my US equity returns are anywhere, say if Indian markets or Indian portfolios can deliver 15% returns to you and 5% is my average depreciation, that brings it down to say 10-11%. Unless my US equity markets are delivering those kind of returns to me, that does not make sense for me. I can very well be invested in India, pay my taxes here at 10%, and then whenever it has to be transferred to the family in US, it can be transferred there.
Okay, very simple approach.
Very, very simple, sir. Again, sir, going back to objectives, uncomplicated objectives, and uncomplicated approach to things, sir.
Okay, then coming back to, let's say, the private company investments, which somebody had asked.
Right.
See, you
Right.
mentioned that you have an NBFC. Will your NBFC lend against private company investments? And what is the advantage of doing that?
Right. A private company, again, they will, depending again what your needs are. So the interest rates will change on the kind of needs you have, because if you're investing in good asset classes which are secure, and that is what your letter of intent also says, you will get interest at lower costs. But again, if you're not looking to invest, or if you're just looking to keep that money and plow that back into your company, of course, those interest rates will depend on that. So the benefits of that is
let me
you
give
can
you an
manage.
example. Let me give you an
Yes,
example.
sir.
Now, let's say investment is there in a private company investment, and therefore, if we come to you for borrowing against that, let us say, you will probably fix some interest rate of, let us say, 11%, 12%, 13%. Let's assume some number.
Right.
Okay, but can you deliver a return higher than 13%?
Right. So if I'm borrowing at 13%, it might not make a lot of sense, first of all. But even if they do, our portfolios historically have done anywhere between 13 to 15% based on the kind of liquidity requirements or the kind of asset allocation we've had. But Yes, if unless it's not making more than 13%, probably I will not want to do that. And if I know that it's a 13% borrowing rate, I will probably not want to advise that. So that's a very, very high cost. Because again, our NBFC lends as high as maximum 9.5%, not more than that. And our portfolios have a tendency of delivering 13 to 15% returns. So borrowing at 8.5 or 9.5 makes a lot of sense for us, because we are able to create that 5%, 6% extra money absolutely without the investors' money, absolutely out of thin air.
Okay, so
So
you are able to
13%
able to leverage in this manner using your
Absolutely, sir.
NBFC?
Absolutely, sir. So this is what we've been doing for the last 6 months. When markets have fallen till 15,000 levels, and our investors who have, say, anywhere between 5 to 10 crores, we've leveraged part of their portfolios. We want to leverage a maximum of only 10% of their portfolios, because ultimately it is only because it's borrowed money. I don't want to be invested in a very, very high risk scenario. We invest in market-linked debentures, as I was mentioning, which has a back-tested probability of 87, 88%. If I have a success probability of 88%, I don't mind borrowing money, because that borrowed money will give me returns. So when markets have fallen, we've actually leveraged portfolios, taken 10% loans on the portfolios, and invested close to 50 lakhs, 1 crore for each of these investors, which increases my IRR on an annualized basis anywhere between 1 to 2%. So we have done that, sir, and it's been an absolute game changer for us and for our investors also.
I will stop now because I'm sure others have questions which they're not asking. Right?
Sure, sir. Happy to take more questions if you have, sir, after the call as well. No problem. We'll be very happy to connect with you individually.
I had missed the last part of your answer of for transfer of property to US through trust route. Can you repeat it?
Right. So again, whatever money you have, whatever assets you have, it can of course always be in a trust today. If it's in a trust, the day the trust has to be liquidated, it will go to your beneficiaries. So if your beneficiaries are in the US, whenever the trust has to be liquidated, it can get transferred to them at that point. But there was also one more question, which was about off-market transfers, sir. But if you hold a financial asset in a form of a stock or a mutual fund or unlisted shares, you can transfer that through a DIS. It's a delivery instruction slip through off-market route, where you transfer from your own holding to a trust's holding in the form of a gift. So if you bought that property at 100 rupees, the day you transfer it is for 150 rupees. And the day the trust sells that at 200 rupees, the gains will be on the initial purchase of 100 rupees and not the transfer value of 150 rupees.
Okay. If I have the agricultural lands, if I transfer that to trust, if my beneficiaries are NRIs,
right,
will FEMA allow that?
Your trustee, your managing trustee has to be an Indian resident.
Your
second trustee has to be Indian resident. Your beneficiaries can be NRIs. But it is not advised just because of stamp duty, sir. Your transferring of agriculture, land, etc. is just not advised for stamp duty reasons. Any other questions, or else I'll want to answer Shilpa ma'am's question about what should we do on Monday morning. Oh, any other questions? So Shilpa ma'am, trying to answer your question now. What should we be doing on a Monday morning? So again, I'll go back to my objectives very, very quickly. So we want to create consistent 13, 15% returns. And because it's a couple of lakhs, not necessarily to invest across multiple asset classes here. Equity itself will do well for us. We invest in equity in mutual funds. Now, the method in which we go ahead and select our mutual funds, it's a very, very rigorous process where we've looked at 8 categories of mutual funds. So out of those 4 or 5 categories of mutual funds is where you can put in your money. Something like a large cap fund. Why is a large cap fund good? Because it ensures consistent returns, which is one of the very, very key objectives. Because Nifty 50 is a list of 50 companies and my large cap companies are my top 100 companies. So it will tend to do whatever my Nifty is doing. But I want some extra returns over whatever Nifty is doing, which we call an alpha, right? 2 to 3%. So we want to have some exposure in a flexi cap fund, a mid cap fund, a focused fund, and a small cap fund. 5 sectors only, not necessarily to overcomplicate it. And I don't mind sharing a couple of representative fund names also, so that you can, of course, go back and look at it. Because while we have gone ahead and selected these mutual funds, we've put a lot of confidence in it. We're a listed company, our performance depends on this performance as well, right? So you can take a lot of confidence in what we have to offer. So in the large cap category, Franklin India Blue Chip is a very, very good fund. The reason we recommend this fund, I'll try and give you rationales for a couple of these also. So Franklin India Blue Chip, which is a large cap category fund, and into the flexi cap category, there's a fund called HDFC Flexi Cap. These two funds, HDFC Flexi Cap was also one of the representations in the example. Now, the reasons these two funds have been chosen is because they have a very, very good future potential in place. Because while we invest, we look at historical data to have a mindset that what should I be doing? But we're investing only for the future. So we should have some assumptions or some expectations in mind. So while we come to those decisions, we use something called a target price 12 months from now, right? So the target prices for these two are very, very nice. This is something which we had recommended last year. These two were not very, very good performing funds for the last 3 to 4 years, but the future looked very well from the last year till now. So we went ahead and recommended these funds, and these have been one of the top performers in their respective categories. So for large cap funds, you can choose Franklin India Blue Chip Fund. For flexi cap, you can choose HDFC Flexi Cap. For mid cap, you can choose DSP Mid Cap. For focused fund, you can choose SBI Focused Equity Fund. And for small cap, you can choose Aditya Birla Small Cap Fund. These 5 funds, you can have equal allocations. 1 lakh, 2 lakhs, that is good to start with. But as you keep growing your corpus, and if you want to have active management, by now you know who to get in touch with. So I'll be very, very happy to help you with that.
Anything on small cap?
Aditya Birla Small Cap Fund. This also comes with the very, very same rationale. It's not been an outperformer historically, but we have very, very strong belief in that. The fund manager who was managing this before has left the fund. We have a new fund manager since the month of April who comes with 15 to 16 years of experience only doing small cap and mid cap. And he's delivered about 20 to 23% returns on the PMSs which he's managed historically. So we have a lot of confidence that he'll be able to replicate the same thing in the small cap category also. So small cap has, just reiterating the 5 funds. Large cap has Franklin India Blue Chip Fund. Flexi cap has HDFC Flexi Cap. Mid cap has DSP Mid Cap. Focused funds has SBI Focused Funds, and small cap has Aditya Birla Small Cap Fund. So in focused funds, as we were discussing, sir, about international exposure. So SBI Focused Fund, as a fund, it invests about 8 to 11% of its corpus into FANG stock, something like an Alphabet or a Meta or an Amazon. So that is where we get very, very small exposure in foreign equity for that.
Is this TSP mid cap?
TSP, D for Delhi, S for Singapore, P for Punjab, TSP mid cap.
And is it the right time to invest?
You could wait a little bit, just wait it out a little bit, because again, there could be a 5-7% correction from here. We're not saying that it will happen. There could be, again, because you never know when the bottom hits or when the peak hits, but just stagger it for now, or probably just hold on to it for a while. Again, going back to trying to answer the liquid funds wala question, what we like doing is in markets like this, you put in your money in a liquid fund or a money market fund for these respective funds. Say if I'm recommending HDFC Flexi Cap Fund to you, for now, you can put your money in an HDFC money market fund so that it at least generates more than whatever your bank has to give you. And the day you think the markets have corrected a bit, you switch from your money market fund to your Flexi Cap Fund.
How much is money market fund giving now?
Anywhere between 5 to 6%, depending on the fund which we go ahead and choose.
How are you telling it's better than FD? Matlab, short
FD
term.
में आपका lock in होगा, plus उसमें taxes extra लगेंगे. This will at least give you a little higher returns because it is
This
marked
return
to
is not
market.
taxable?
This is, again, this will be 30% on whatever we sell, or your gains will be taxed at 30% because this will be short-term debt. But your probability of making returns higher is there. With fixed deposit, it is fixed. With a bank, it is fixed. But as soon as it's a money market, we have some room for extra returns as well. Is the idea. And it gives you flexibility because the day markets fall, you can instantly switch and you will get that day's price. As compared to you having money in your bank account, transferring it, trying to buy, and if you miss the deadline given again our professional capacities, you might not be able to enter that day. Although market timing only has a 2% impact on your returns, short term it does impact, right? And it looks nicer to us. We've invested money and it started giving us returns. That's the logic.
You can share your contact details just in case some of our members
Yes.
would be interested.
Absolutely.
To reach out to you.
Absolutely. So I'll leave my email ID and phone number here. I will be very, very happy if I've been unable to answer a couple of questions. I'll want to answer them as we go along. And there are a couple of questions which I've noted down. I'll try and answer them and leave the messages with Vijaya ma'am whenever she can address the group with it. And again, so very, very happy to be here. Very, very to be trying to answer your questions. I know I've been unable to answer a couple of them, but very, very interactive session. Thank you so much for your time. I'll share my contact details. If you think I can add some value to you, your clients, your family, please feel free to reach out to me. We'll, of course, the fee structure is something which you've not discussed, but of course, we will discuss that if this is of interest. Because fees is something which brings people down. I don't want to do that on Saturday. So thank you so much for having me here. And thank you so much for a very, very interactive session. Just sharing my contact details here. We'll be very happy to hear from all of you, any of you.
On behalf of Bangalore Valuers Association, I'm extending formal thanks for today's speaker, Mr. Shreyan. It has been very interactive session. Our focus is, especially it's on a weekend, we have little time to do research and,
Yes.
if this time we can use for aligning our objectives, or rethink on our objectives and, the investment perspectives, what Mr. Shreyan has shared with us, maybe for us, for our extended family, for our clients, then
Yes.
I hope this session will be, useful, was useful to all of you. Thanks a lot, everyone, for participating in today's session. Yes, we call it a day. Have a good day. Have a happy weekend. Thanks, Mr. Shreyan. Our
Thank you so
sincere
much, ma'am.
thanks to Kusum also for arranging this
Yes.
session and today's speaker. Okay, all. Bye for now.
Thank you so much. Bye.